Welcome to the WealthStack Podcast. I'm your host, Shannon Rosic, Director of WealthStack Content Solutions. Today, I'm joined by Vickie Lewin, the Chief Growth Officer at Amplify. And today, we're going to be tackling one of the biggest shifts in the industry, the rise of the independent and breakaway advisor, which means we'll also get into why this shift is causing advisors to really rethink how they operate, scale, and leverage technology. So Vickie, welcome to the show.
Thank you so much for having me.
I've been looking forward to taking a deeper dive with you and having this conversation, but I actually want to start with your background. And I promise this is actually the hardest question you're going to get this entire conversation. And you've had an impressive career from Nuvve to FundQuest to AssetMark. And I want to know what makes Vickie, both professionally and personally.
Thank you. So, Shannon, it's probably only a hard question because there's 35 years of the professional journey. And it's just amazing how fast they went. And it's also amazing how much the industry changed during that period of time that I joined. So I've always been in financial services from the moment I graduated the Ohio State University in 1989. I graduated on a Saturday, went to work in financial services on a Monday. And, there's a lot of people that were, either in our industry now that either weren't born when I started in the industry or, we're still in grade school. And the amount of evolution that's happened since then has been amazing. I was really fortunate. I didn't know it at the time, which I think a lot of people look at when they think about their career. But I was really fortunate to very, very accidentally end up on the fee side of our business when the fee side, advisory side of the business was being created. I worked for Invesco, which was one of the original Schwab OneSource members when Schwab created OneSource. And that was the very first time that advisors could trade between mutual fund families for no transaction fee. From there, I went to PMC, still a part of the Envestnet family of companies, and was teaching advisors what wrap programs were, because that's what they called TAMPs early days, was wrap programs, because we were wrapping the fee and what they were. So early days when the industry was created, I was, lucky enough to find myself at Invesco and PMC, and then Investment Advisory Network, which was acquired by SS&C Technologies, which was the technology for AssetMark, which is how I ended up there. I knew early in my career, I knew I liked working for financial advisors. I liked the work they did. I liked the mission. I liked trying to help make a difference in the lives of clients. And then very quickly, I also learned I liked the advisory side. I like the fiduciary model. I think it's the right thing for the end investor to be served by someone who is obligated to put their interests ahead of their own. I'm a fan of that. I love the advisory model, the notion of a financial advisor always being on the same side of the table as the client, being able to help them find the right solution, right opportunity, right time. So I've enjoyed my journey on the financial advisory side of the business. AssetMark was a good long part of my journey. It was so exciting to be there early days when they had this vision of an open architecture TAMP, and then to see how that evolved. And now I'm really enjoying this brand new chapter at Amplify that I started in June, which is really about just redefining what a TAMP is, taking the walls, getting out of the box of that traditional TAMP model and thinking about all of the other things that it can be, which is all the stuff you said earlier. It's scale, it's personalization, it's customization, it's being able to give a firm what they want and advisor what they want. So I'm very much wrapped up, no pun intended, in the advisory side of the model, and I'm real passionate about that. So that's the professional side. I love working with advisors. I love helping them make a difference. I love helping them spend more time with clients. I love seeing them build, the business that they want to build, and all the things that I've done have helped me be a part of those conversations and see those changes. And then on the personal side, I'm going to go ahead and say I'm a big Ohio State football fan. I'll save you the OHIO gesture in the box. My husband and I have 5 grown children. I have 1 grandchild so far. I'm sure there's going to be an army of them on the way, and I'm loving this empty nester chapter of my life.
Well, I love it. We are two Ohio girls in that sense. I went to Miami.
Great spot.
So not as great as football. We've had some legends there, but the Ohio State is certainly a fun campus. I had a bunch of friends go to grad school there. So Ohio will always hold a very special place in my heart. But I just have to say, you know, your passion just comes through in the way you talk about working with advisors. And it is obviously showcased in your incredible career journey. And just to give listeners a sense of Amplify a little bit more, and maybe for folks that aren't as familiar with the firm, you know, just give us the quick pitch, you know, who you serve, where you sit in the ecosystem, and what the mission is.
Sure. So we're an up-and-comer. We're a newer entrant to what I will call the TAMP, trying really hard to be more than a TAMP and get outside of that traditional, somewhat limited definition. But it's probably the best place to most easily describe to an advisor or an owner of an RIA what we do. We primarily serve RIAs. We also serve some small broker-dealers and hybrids as well. I classified it as an all-in-one advisor operating system, but all of the definitions of what advisors and RIAs think of as a TAMP apply. We can also be the technology that helps a firm build their own TAMP, which is why I'm trying to get people to just think beyond that traditional definition.
Build their own. Dig into that a little bit and what that reception has been.
An RIA or a small broker dealer, you know, who has 100 or so, and it could even be fewer than that, advisors, and has an idea of what they want their asset management offering to be to their investors. What models do they want to use? Do they want to build their own? Where do they want to custody? How do they want to price it? What do they want to call it? Amplify can actually be the technology that powers all of that. So completely white labeled, Amplifies in the background, sort of, you know, kind of like, you know, powered by Intel, or Intel inside, I guess is where I was trying to go with that example.
And you say that you're an up and comer and newer to the space with Amplify, but Amplify recently doubled its headcount and surpassed 18 billion in AUM. And that's just an incredible trajectory. So besides bringing you on board, what were the other biggest growth drivers, you know, behind this success in the last year or so?
Yeah, we did. And, you know, the first, I always say to firms growing, the first billion is the hardest, and then the first 5 is the hardest. So I'm going to say with us, I think the first 20 was the hardest. It's a great milestone. I'm avoiding celebrating. I think we may have hit that. I think we may have hit 20 today, but I'm trying to avoid celebrating because all kinds of bad stuff happens when you do that. So, you know, Amplify was born out of an RIA, Ashton Thomas. It was built because of Aaron Brodt, our CEO, as well as Ashton Thomas's frustration with technology. It didn't do what he wanted, how he wanted, as fast as he wanted, with as few clicks as he wanted. It wasn't integrated. And so finally, in that frustration, he's like, you know, to heck with it. I'll just build it myself. And so he hired a really brilliant developer, David Hatfield, who's our chief technology officer today. And, you know, and off they went. And off they went building it for them. They never really at the time thought about what that might look like in terms of offering it to other, to outside of Ashton Thomas. And then as Aaron went around traveling to conferences and the like, and, you know, people talk, what tech do you use? What tech do you use? Aaron started talking about what he had built, and someone asked him, would you ever consider selling it? And so, that was a light bulb moment for Aaron where he thought, well, heck, why not? So, you know, going back probably just, 2 or 3 years ago, he started to offer the technology to other firms to, in some cases, build their own TAMP, in some cases, power their advisory offering, in some cases, help with trading. It really is a customized offering based on what firms want. And so we grew through just word of mouth. For a long, long time. And it wasn't, Shannon, until they hired me last June, where they said, we're ready. It's time to do a full-blown go-to-market strategy. We think the industry is ripe for disruption. We think that there's a lot of RIAs out there that are looking for something a little different than what is already there. And let's go try it out. So when I joined, that's exactly what we did. We were everywhere. You can imagine. I saw you at some of those places, out at all the conferences, testing out our message, and it's resonating. It's resonating. Our pipeline is fuller than we can handle onboarding at the moment, which is part of the reason that we're hiring like crazy. We need a fully staffed and trained onboarding team. We need a fully staffed and trained relationship management team. We need a fully staffed and trained trading team. I need more salespeople. I need more client relationship managers. And we need all of those people because the demand is there. And I'm not willing, and our owners are not willing to bring on clients that we can't delight every step of the way. So we needed a little bit of time to just get our act together internally with personnel and staff so that we can bring on the clients with the speed at which it appears that the marketplace wants.
Well, I hope then these are not bad problems to have when you are in full-blown growth mode.
Yeah, champagne problem. If I had a glass in front of me, I'd toast you.
Exactly that. Well, we'll definitely do that soon here in Nashville. Sure. So, but I appreciate the background and context. But I want to dive into our first segment that I call Stats All, folks, and kind of get into the meat of the conversation. We promised folks we'd talk about the shift in breakaway and independent advisors. And I found this interesting stat from Cerulli, because they're projecting that RIAs will control nearly 1/3 of advised assets by 2027, which is literally right around the corner, which is up from 27% today. And not to call out wirehouses, but it's virtually switching spots with wirehouses in a statistically zero-sum battle for market dominance. So I'm just curious how you're viewing this shift and how you see that reshaping the industry with this big push for independence.
Yeah, it's interesting. That shift started, Shannon, all those years ago when Schwab created OneSource and even created the opportunity for people to have the model. And then it accelerated tremendously with this trend from, I'm going to say, commissions to fees. I'm not even going to go to fiduciary just yet, but it started with the trend from commissions to fees, where a lot of advisors and a lot of businesses were saying, let's get out of this commission rat race where we have to sell something all the time in order to, pay the bills, keep the lights on, pay the mortgage, pay the kids' tuition, right? That's an awful treadmill to be in. And it doesn't create an opportunity for advisors and firms to really take care of existing clients when they're always chasing that commission. So it started with the trend from commissions to fees, which then was accelerated by the regulatory environment of the trend to fiduciary, which is the fee-based model, right? Which is the advisory model. And consumers, we know, met that shift of the trend to fiduciary. They met it with great excitement. They don't want to be sold something just because they don't want to be sold something. They want to be taken care of. They want to do nothing when nothing is the right thing, but they want their advisor to be able to make money. They want planning advice. They want estate advice. They want tax advice. They don't want to be sold a product. And so that shift to the fiduciary really accelerated it. And then most advisors that I've had the opportunity to work with over these 30 some odd years, they don't want to be told what to do. They want to run their business the way they want to run it. They want to serve their clients the way they want to serve their clients. They want to offer the products that they want to offer. And the broker-dealer landscape, it just got really restrictive. And it got really restrictive as the broker-dealers got bigger and the regulatory environment got tougher, because they had to regulate, and I'm going to say what I hate saying, but it's true. They had to regulate down to the lowest common denominator. Right. So that really awesome advisor who wanted to do great planning and tax and estate work and offer alternatives because it was the right thing. And that when you're told you can't do that, right, most individuals are going to say, I'm going to go find a way. And so I think when you marry all of those things together, that trend is only going to continue to accelerate, because those things that I just talked about aren't going away.
Well, like you said, this shift to independence, it really just continues to gain momentum, and advisors are really making the move for a variety of reasons. And to your point, one of the biggest reasons is just greater autonomy, and followed quickly by higher payout, and then building a practice for succession or sale. And so I'm curious, from your perspective, which of these factors is driving, you think, the most interest today? Is it that true control? And, how should advisors be thinking about independence strategically? as they really plan their transition to maximize those types of benefits?
Yeah, Shannon, I think it starts with a spark on any one of those things, right? It starts with a spark of a firm lowers my payout. And then I'm like, hey, wait a minute, I don't like the fact that my payout was lowered. And then, the avalanche of all the other things that they don't like. I think most of the time it starts with the desire to be independent and to be able to do what they want, when they want, the way they want it, with the products and services that they want. But then when you wrap around that, but hey, wait a minute, you mean that I can have this independence and I can make more? And I can build a business that has shareholder value for me, that then someday I can monetize, that might actually end up being the biggest asset on my balance sheet at the time that I do. When you wrap all of that together, I don't know how anybody stays.
Yeah, no, absolutely. I completely agree with that. How do you justify it at that point? But because this is a tech podcast, I want to get into the more technical side of things. Especially when it comes to going independent or breaking away. Obviously, one of the top things advisors need to consider is their tech stack, or at least having to rethink it and reevaluate. So what do you see are some of the biggest challenges advisors face when modernizing their infrastructure? And maybe what strategies can help them stay ahead? Because there's now, 500 wealth tech applications out there that we've battled the shiny object syndrome. There's a whole litany of items. So how do you focus and get it right?
Oh, you and I could talk for hours. We could talk for hours about that with hopefully a bottle of wine
yes, please.
in front of us. There's a different stage of that answer depending upon where an advisor is, right? For somebody that's trying to break away, if they want to break away quickly, there's a lot of decisions to be made. So sometimes for an advisor that wants to break away quickly, the right answer might be to join an already established RIA that has a lot of that stuff figured out. And maybe they'll get lucky and they'll partner at an already established RIA that already has all the tech offerings that they want, because there is a lot to consider. What is my CRM going to be? What financial planning, tax planning, estate planning technology am I going to use? How am I going to trade? Who am I going to trade with as my custodian? Am I going to use separately managed accounts, model providers? How am I going to contract with them? How am I going to do billing? How am I going to do reporting? What kind of a client portal am I going to create? What's my client experience going to look like? And I'm sure I missed a few down my path there. So there is a lot to consider. Now, you've seen the Kitsy's tech map. I love it. I love every time they publish a new one.
Me too.
I don't know how they're going to keep that thing on one page for much longer. The font just gets smaller and smaller, and the logos get smaller and smaller. But it's really fascinating to look at the tech map going back to 2018. That was one of the last ones I could find. I'm sure there's another one. But you go back and you look at it in 2018 and you look at it now. And in 2018, maybe there were 50 different total choices to consider across all of those categories that I just mentioned. And now that's hundreds and hundreds and hundreds. So it's, the challenge is that it's overwhelming. And as human beings, when we're forced to make a choice, we don't want to make a wrong choice. And so oftentimes when we're don't want to make a wrong choice, we make no choice at all. Right. And so that's a struggle. So the sheer volume of choices to make is tough. And it's the reason why two things are happening. Number one, a lot of consultants are now popping up saying, hire me. Let's figure out what your vision is. Let's figure out what you're trying to build. Let's figure out your niche, and I'll help point you to the right ones for integration. That's one of the trends. And then the other is these all-in-one platforms. And you can put Amplify in that category that simply say, look, there's a lot of choices out there. Let's streamline it for you. Let's make this easy. We'll have the data all in one place, and you can still be multi-custodian. So I think that is part of the reason for the emergence of the all-in-ones, just because there's so many choices, creates so much complexity. And then you end up with data in all kinds of places, and the systems don't talk to each other. And then everybody gets frustrated. So that's what the all-in-one category is trying to solve.
Well, the analysis paralysis is extremely real in our industry. And I want to put a pin in the all-in-one because that's for our next segment.
Okay.
Funny enough, because I was going to dig into that with you. But then when I was sourcing questions on social media for us, that was the number one question that came through. So I'm saving that here in just a couple minutes. We'll get into that. But I'm curious, as firms really look to the future, I know one thing that you're passionate about too is empowering that next generation of advisors, because that's key as folks begin to retire. We've all seen the stats that we're going to have a huge dip when it comes to advisors in our space, with folks moving out or succession planning or whatever it may be. And so this next generation is expecting to be very, very tech enabled, very savvy. So beyond things like technology providing that, bird's eye view of firm-wide operations, talk to me about how you envision that next generation coming up. How do they maintain the human touch while still enabling personalization at scale? And how do they set themselves up to ultimately be successful here down the road?
Yeah, what a great question. So one of the first challenges we need to tackle, Shannon, as an industry is finding more of the next gen. So, one of the things I'm sure you've read about is there's, going to be a large shortage of financial advisors. And if that's true, then the ones who do decide to come in are really in for an amazingly awesome opportunity. They are going to be asked to serve more clients. They are going to be asked to serve more clients at a lower fee. They are going to be asked to really personalize the offering from the way data is visualized and accessed all the way to how they're communicated with. And so I don't see how the next generation can be successful in doing all the things that they're asked to do without integrated, simple, easy to use, intuitive technology. And I think that's what all of us on the Kitsy's map are trying to help solve for. I do see one other trend, not only the trend to fiduciary and the trend to independence that we've talked about, but this particular trend really hits your question right on the nose. And that's the trend to outsourcing the asset management. A lot of financial advisors today that are, 55, 60 plus are still managing the money themselves. And it takes a lot of time to do that and do it well. So I think what I'm hearing and seeing from the next generation of financial advisors is not only do they need a simple, easy to use, intuitive, integrated technology stack, but they're also going to outsource the asset management to institutions that do that and do that full time, so that they can focus on clients, client relationship, financial problem solving, business development.
That's interesting because the OCIO side of things has definitely also gained momentum. That's another conversation we could probably talk about for an hour, because I'm curious about your thoughts about that, because obviously, and for folks that maybe don't know, OCIO is outsourced chief investment officers. So outsourcing all that asset management for your firm. But especially when it comes to independence, not everyone can necessarily afford that yet. It still comes at a decent price point to be able to do that within your firm. So I'm curious, are we going to start seeing things level out there? Are we going to start seeing more of it? Where do you kind of stand on the whole OCIO side of things?
So I think advisors can outsource OCIO at all price points, all levels of service, right? Some firms may want a completely customized, completely curated. I want these models to look, smell, taste, act just like my firm and nobody else's, right? And that's going to cost a little bit more to hire an OCIO that does that work for you. But then, Shannon, firms like ours that are in the space, we offer access to separately managed accounts and model providers. Don't forget the AI component of portfolio optimization that's coming up. So, firms like ours are going to give advisors the ability to say, hey, I like these 5 separate account managers. I like these 5 model providers. These are the 6-ish types of client profiles that I typically encounter. Now take all of these ingredients and put them through your optimizer and tell me what mine should look like. And that isn't that expensive. So all of the technology that's being developed there can help advisors be better advisors, firms build better firms build better models that are better suited to their niche, and Amplify, as well as many of the others, are already doing a lot of those things.
Well, thank you for indulging me because I just learned something, so appreciate it. So before we get into our next segment, I have to ask then, what's next for Amplify? Are there any new features, integrations, partnerships in the pipeline that folks should be excited about?
So yes to all of yes to all of that. And my greatest frustration is that we can't do it all at once faster. But I'm sure that's the frustration of every firm in our business. Right now, Amplify is really focused on data. We're focused on helping Amplify, for firms that partner with us, be the single source of truth. So we're really focused on how we make sure that we have data integrity, how we make sure we're shipping it in from all of the different places that an advisor or firm might be getting it, so that we can provide the really valuable data insights that firms need, so they can make the right choice at the right time, and the right next action with their client, protect their firm in the right way, all of those important things. In addition to that, we are working on expanding our product marketplace. Many firms call it a model marketplace. We're especially focused on the word product versus model, because we want to include things like annuities in the marketplace, as well as alternatives, because advisors want to use all of those things, not just the traditional models and SMAs. So we're trying to think about how we can pull all of that into the product marketplace. In the marketplace, we want to make it easier for advisors to shop, if you will, for the right product, be able to compare and contrast like you can do on a service like Amazon, be able to understand how products behave together in a better way. So we're working on that. We are working on a new risk scoring mechanism, not just off of the investor's risk tolerance questionnaire, but also off of every single security and every single product. Riskalyze, now Nitrogen, really did a great job of bringing this notion of risk scoring to investors. I think they did a great job of teaching advisors how to market to bring in business. But I think our concept around risk is a little bit of a better way to score the risk. It's based on tail risk and not time. So we're working on risk scoring, so that investors, compliance officers, advisors can just make sure that what they have is aligned with what they want in a way that advisors can see easily. And then finally, the priority for this year is this concept of helping advisors be better advisors. And what I mean by that has to do with that OCIO optimization piece that I was chatting with you about. So if an advisor builds a portfolio and it's 20% in 5 different SMAs, for example, the optimizer can go back to an advisor and say, hey, if you put these together, you can have those same 5 ingredients, but put them together in a slightly different allocation. You can get a better return for less risk. You can have less risk, same return, and some variations inside. So we're working on that and plan to launch this year as well. And then we're leaning hard into some custodial partnerships, especially with some of those that are trying to be a little disruptive to Schwab and Fidelity. We do have Schwab and Fidelity as custodial partners, so I don't want to, stomp on them there. But there are firms like Goldman Sachs and Axos that are trying to be a little different and offer something a little bit different. And we're leaning into some fun partnership concepts and ideas with those firms that we're not quite ready to take. We're not quite ready to share all of the details with, but we should be before the summer gets here.
All right. Well, we'll wait for part 2 then. That's fair. But it's just very clear that you have, the advisor top of mind as well as their end clients, and the vision is very clear over at Amplify. So appreciate you sharing. But it is time for segment 2, Vickie, that I call Ask Us Anything, where I've gone out to the social universe and asked folks to submit questions they want answered by you. We had a few folks slide into the DMs this week. And so I promised we would get to the all-in-one topic, because this came up a few times in my messages. So putting you in the hot seat here if you're ready.
I'm ready.
All right. This user said, here's my super simple question. What's better for growth-focused firms? Best of breed tech solutions or a unified platform that rolls it all together, and why?
Yeah, Shannon, for an emerging firm, I'll say the reason an all-in-one can be a better answer is because you can get from point A to point B the fastest and most easily. Right, the best in breed technologies. There's a lot to offer there. We learn a lot from what they're doing. We try to implement some of their features where we can, but it does create complexity, and complexity can slow a firm down. So all-in-one is really just about speed, scale, enhanced growth, and the fastest way to get from point A to point B, which is I want to build a business. I want and I want to serve my clients.
I love that, because this whole debate of best of breed and all-in-one has been raging for a while. So I think, to your point, like you said, it kind of just also depends where you're at in your growth trajectory too, right? It has to make sense for your firm and your business model. So love that answer. One more loaded question for you. With AI and automation shaping the future of wealth management, where do you see the biggest opportunities for advisors to leverage these tools effectively?
Thank you. I'm excited about what AI is going to do for our industry. I'm on the tail end of my career, but I think back to all the innovation that happened over my 30 some odd years, and I can't even imagine what this is going to do for innovation over the next 35. I'll be on the receiving end as somebody's client who's implementing all these great tools, and I'll look forward to that. Shannon, right now in this moment, the tools that I'm seeing advisors use that are making the biggest difference is just those that help with productivity. So the simple ones, the note takers, and man, they're awesome. The note takers that can very quickly summarize a meeting and assign tasks, and you can get them to your CRM and activate whatever's happened. Even the speed and efficiency and accuracy with which people can follow up. I think those are great. I don't know about you, but I use ChatGPT almost every day. Just to,
yes, guilty.
Just to make sure I've thought about something all the way, right? To maybe help me edit something that I've written in a crisper, more concise way. So I think everybody's using that or should be using that. As a marketer, that it's so much easier to edit than it is to write from scratch. And so sometimes, getting that little lift and support is helpful. What I see coming really quickly is some of the AI tools around optimization that we talked about a little bit. Some of the AI help with research. So if an advisor is on the receiving end of phone calls from clients, tell me what you think about this, that, or the other thing, what's going on with gold, interest rates, how this is projected, them being able to use an AI tool to source a really quick answer that their firm is comfortable with, so that they're giving consistent answers across the firm. I think that's one that's being used more often. But the productivity tools, I think, are the easy ones to implement today that I think, at least since AI is still so new, make people the less nervous is what I'm trying to say. But, when I started in the business, Shannon, the web didn't exist. Like, it didn't exist. I used to say to ask advisors, do you have a website? You need a website, right? And now you think about how transformative that's been. We're in the same place with AI. Right. We're in the same place with AI. We're in the very, very early innings of figuring out what it is and how we use it effectively. And man, I can't wait to see where it takes us. It's going to help us be better, faster, and do all of those things that this next generation of advisors is going to need.
Oh, absolutely. And just to your point to ChatGPT, it feels like an extension of my brain most of the times, because boy, does it help when I have like writer's block or I just need to ideate on something. So yes, if you are not dabbling with that, you are unfortunately already behind.
Yes.
Is my opinion. But Vickie, I appreciate you being put on the spot and your incredibly insightful answers. But we have come to our final and what might be my favorite segment that I affectionately call Stack It or Whack It. So I'm going to throw out a few technologies, and they're not necessarily always wealth tech related, especially if I know you. Sometimes they're random ideas or thoughts, and you tell me if they are essentially worth the hype, stack it, use it, or whack it, lose it, hate it, whatever. So I know that you are also an avid golfer and tennis player. So I have to ask you, stack or whack smart golf balls? Is it good to know that much about your swing, or is it simply a distraction?
By avid golfer, let's call myself an aspiring to be good golfer. So I'm going to probably spend the rest of my life working on improving my golf game. The The smart golf balls are really cool. What they can do, I mean, it's really amazing. Now, as for me, somebody who loses my ball all the time, getting some help going to find it would certainly be pretty awesome. However, at the current price point of $50 or so a golf ball, I don't know that I could stomach that. Now, maybe I'd be smart enough to know not to hit that particular ball when I was trying to get over or around the water. But I don't need any other reasons to be a frustrated golfer, and losing a $50 golf ball would be pretty frustrating to me. So I'm not ready for that yet. Maybe when the cost of that technology comes down a little bit, I'll be ready to give it a whirl.
All right. So that sounds like a whack it to me then for now.
But it's cool. They just need to be cheaper.
I think that's completely fair. All right. One more for you. Pickleball over tennis, pickleball is the fastest growing sport in America, and there's courts being built, I feel like, on every corner. Are you embracing the trend or staying loyal to your tennis roots? Stack or whack?
Yeah, pickleball. It's easier on my knees.
Fair. That is fair.
And I can also say, I don't know if you knew, I played tennis at Ohio State. So in my head, I'm still as good as I was when I was playing for Ohio State, and I will never, ever be that good again. And I don't have that same level of arrogance with pickleball. So pickleball.
That same level of arrogance. I love that description. All right. So we got one whack, and then it sounds like a stack then for pickleball. Love it. Well, Vickie, it's just been an absolute pleasure chatting with you and getting to know you more and learning more about Amplify. Please tell listeners where they can find out more about you and what you're working on.
Awesome. Thank you. Well, amplifyplatform.com. We'll be launching a brand new website sometime next week. So I'm anxious for people to be able to see what we are showcasing there. And then I'm pretty noisy on LinkedIn, so people can find me on LinkedIn and see what we're up to there as well.
Love it. All right. Well, shout out to the new website. Be sure to check that out, and be sure to like and subscribe to the WealthStack podcast on all major podcasting platforms, and follow all things WealthStack on wealthmanagement.com, LinkedIn, and X. And if you want the in-person WealthStack experience, well, join me June 10th through 12th at the Boca Raton Resort in Florida for Wealth Management Edge. Thank you all for tuning in.